Hi, Catherine. President Trump just imposed a 10% tariff on all imports from China, but it's also threatening to revoke the de minimis rule, which basically allowed Chinese e-commerce retailers like Temu, Shein, and Amazon to avoid paying import tax for goods less than $800. Now, Chinese e-commerce retailers have been enjoying significant price advantages over competitors. If this rule is revoked, what will be the impact on the price of Chinese imports?
Right, $800, John. It's a very high, threshold in US relative to Europe, select markets in Latin America as well as Asia, whereby we're looking at duties being imposed on goods that's more than $200 already. So essentially, that has been the loophole or the window that has made US such an easy market for newer platforms like Temu to enter into 2 years ago. And then through this loophole, they were able to actually grab e-commerce market share from Amazon and other players that has been operating in the country. So going forward itself, as the threat continues to linger, I do think that, there's going to be changes to how supply chain from e-commerce platforms itself, not just Temu, but Shein, and some of the Chinese sellers on Amazon as they rethink how to actually bring goods from China into United States.
And how do you calculate the impact on the retailers?
Mm. Well, I would say that let's not forget that essentially we have third party sellers on these e commerce platforms or the e-tailers, as you've highlighted, Temu, Shein, Amazon, and Amazon specifically, they are still reliant on 60% of independent sellers to sell on their platform itself. So what's going to happen for the sellers is that, as they use the platform to sell the goods, they're going to be charged an additional 10% tariff on the factory prices of products that they have sourced and will be selling. The good news is that retail markup is essentially in the range of 4 to 5 times above factory prices, meaning that 10% on the cost itself is not going to be a significant thing, particularly if you're talking about sourcing a $2 t shirt from a Chinese factory itself that ended up selling in the market for $10. The good news is that, the tariff will only have about a 20% additional impact.
And Catherine, what would happen if Trump imposes the worst case, say a 60% tariff on Chinese imports?
I hear you, John. Never say never, and we should be prepared for this threat. We have set up a calculator to help sellers as well as watchers of this development do a very quick back of the envelope calculation onto potential impact to product cost, retail prices, and essentially what sellers themselves need to do to make sure that they remain profitable in this business. On your screen right now, for instance, in our calculator, we have set up a 35% tariffs or import duties, which currently includes the section 301 25% that's imposed on a Chinese made in China t-shirt. We've added a 10%, so much so that that becomes 35%. So essentially, if this itself becomes a additional 60% tariff that President Trump would like to impose on made in China t-shirts, this will result in a 95% increase in product cost for sellers on platforms like Temu, Shein, AliExpress, or even Amazon if they are not going by the FBA route. Assuming sellers would still like to keep to a 69% gross margins after President Trump imposed tariff hikes of up to 60% on Chinese made t shirts, this would require the seller to raise their product prices by 37%. In the worst case scenario, that they've realized that their target customers are not willing to pay for the higher, pricier t shirts, you are able to actually use our calculators to set and do a scenario analysis whereby you keep product, the retail prices at $10, reducing the retail markup to get to where the eventual margins for the sellers would be if they're not in a position to raise the retail prices. We will have to actually keep monitoring the developments on this, but I do believe that this calculator can be very useful as we track some of these changes.
Thanks, Catherine. And Bloomberg users can find this on the Bloomberg Terminal. Out of the Chinese e-commerce players, who will be the most impacted?
Right. 2 years ago, that would still be PDD's Temu because they were 99% reliant on US shoppers for their overseas GMV. And in the last 1 year specifically, they have accelerated their diversification and gone into newer markets, particularly in EU, whereby that particular region itself now accounts for almost a third of their overall overseas GMV. So right now, where Temu is, based on our calculations and latest numbers from Sensor Tower itself, their reliance on US essentially has fallen below that of Shein. So I would say that right now, based on the numbers, Shein is still most exposed among the Chinese e-commerce platforms.
And related to Shein, the planning to list in London is how is this impacting their IPO price?
Right. Clearly, it's not the best of times, I would say, to actually get a higher valuation, particularly since the threat of de minimis and higher tariff, it's still out there. I would say that, in this current month and probably into the first quarter of 2025, we're going to continue to actually see supply chain disruptions. And notwithstanding, you're going to see uncertainties among shoppers as to whether they are going to be buying goods from China, fingers crossed about delivery delays. So that could actually hurt first quarter revenues as well as profitability for Shein. Now, that could actually settle down, as we step into the second half of the year. So I do think that for Shein's, IPO or plans for that itself, second half may be a better time for them to show that they are able to actually withstand President Trump's tariff threat.
And if this de minimis rule is revoked, what can these Chinese companies do to mitigate the impact?
Right. They will definitely be looking at extracting more savings within the supply chain and specifically from a logistics standpoint. Now, de minimis in the past, and as we speak right now, most of them were actually going by air freight because of the smaller volumes, and then in exchange itself, without the duties, you are able to actually cover the cost of the air freight, which is significantly higher than that of sea freight. It's about a 30 times difference, John. So as we convert to sea freight, which takes longer, what is required right now is that they need to do advanced planning to bring their goods to the US in bulk. And this clearly would involve a lot more collaborations with the e-commerce platform, whether it's via technology, whether it's via embedded algorithm to try and plan better for inventories and delivery lead and lag times.
Catherine, thank you for your insights.